Let's start with him then. There's no escaping him. Investors clearly concerned about more political instability in Italy, what that might do to reforms, etc. Are they right to be concerned, or is this just more of the same?
Well, Italian politics are very difficult to interpret, but I think what this shows is that this autumn is going to be difficult in Rome. Berlusconi, after all these verdicts and the still upcoming verdicts, will try and leverage his support for the government to extract some concessions. I think ultimately it's very unlikely that he will let the government fail, but that threat hangs over it. And the problem with that is that Italy really, the government has its work cut out. The deficit seems to be spiraling upwards. It could miss its deficit target of 2.9% this year by a wide margin, and that will let the alarm bells ringing not just in Brussels but also in Berlin and in Frankfurt at the ECB.
Of course, okay, that may be true, but as I mentioned, there was better news today out on the economic front. We had service sector PMIs in the Eurozone and revised Eurozone GDP. All points to the recovery being well and truly underway.
Indeed, the good news keeps on coming. Moderate growth and moderately accelerating growth as well. The PMIs are consistent with, say, 0.3% quarterly growth rates for the rest of the year. That puts an upside risk to the ECB's forecast of minus 0.6% growth for this year. They may have to revise more than just a little bit tomorrow. And that, of course, raises the question, what does that mean for the guidance of the ECB? Because when they introduced it back in June, it was on the basis of a forecast of minus 0.6%. Does it still hold? Markets will react to that by bringing forward their rate hike expectations, I suppose.
Okay, well, if it's going to be a tough one for Draghi tomorrow, it might be an even tougher one for his counterpart at the Bank of England, Mark Carney. UK services PMIs going gangbusters. How much of a fix does that put him in?
Well, first of all, it's of course very positive news. Monetary policy in the UK is clearly working. Consumers are spending more, they're running down their savings, manufacturing, construction, all these sectors benefit from that. It's really a record-beating recovery all of a sudden. But yes, it does put Carney in a bit of a difficult position, because how can markets really be convinced that interest rates will stay low until the end of 2016 when it looks like the unemployment target of the Bank of England will be hit not in 2016, but maybe in 2015, maybe even in 2014. So a lot of convincing for him to do.
But markets will no doubt bet against the Bank of England. They'll bet on higher rates, higher sterling. Is that a dangerous game?
Well, it will become dangerous for the Bank of England if these higher rate expectations cool down the economy to the degree that this recovery is actually over very quickly. At that point, or if that threatens to be the case, then the Bank of England will have to put money where its mouth is, and it may have to do more to convince investors, for instance, by doing more QE.